Yes. So we are going to look at International Accounting Standard number 23. So International Accounting Standard number 23. It is actually on what we call borrowing costs. It is on what we refer to as borrowing costs. So this is one of the subtopics in financial reporting under special kind of transactions you can actually be involved in as an accountant. So this one also this one is for accounting or maybe financial reporting. But in this case, if you go to IPSAS, International Public Sector Accounting Standards, then it is IPSAS number 5. IPSAS number 5. So we'll see the difference as to in this case you treat what we call borrowing costs under IPSAS, and of course in this case how you treat borrowing costs under what we refer to as international accounting standards, international accounting standards. So just from the title itself, just from the word itself, borrowing costs. So to borrow in this case simply means to get some kind of what you're calling financing or maybe support, maybe from a financial institution or from an external body. So from an external body, so that in this case, you can be able, maybe in this case, to be able to finance your activities. So while in this case, you're having to borrow, maybe in this case, you are an entity or a company or an organization. When you borrow, you'll incur certain costs. You'll incur certain costs. For example, I could end up having to ask, what do you think could be part of the cost in this case? Which kind of cost will you end up having to incur whenever you borrow? Which kind of cost do you think you'll incur whenever you borrow? Which kind of cost will you incur? You can just type in the chat. Which kind of cost do you think you can end up having to incur if you borrow? If you borrow, what happens? If you end up having to borrow, which kind of cost or which cost? You'll incur interest. So there'll be interest. So that is from ESITA. So you'll actually incur what we refer to as interest. Interest, so especially if you get something like maybe a loan, you'll incur what we call interest. Sometimes in this case, if you're involved in, for example, raising maybe capital through borrowing, for example, in this case, debt capital through borrowing, then you can issue up something we call a debenture. And of course, in this case, you can incur what we call maybe flotation costs. Flotation costs could also be there. So this can actually be part of the borrowing costs. Also, in this case, maybe during that point in time, you're having to borrow, there can be fluctuation in currencies. And in this case, you incur a loss on, for example, in the currency in which you're having to do borrow. So there can be, for example, in this case, exchange differences in currencies, So it basically arises as a cost. Because now in this case, maybe you borrowed in a different currency. Then eventually when you retranslated to your own currency, in this case, it simply means that in this case, the value, basically the cost you're having to incur on the borrowing is actually rising. For example, in this case, there was this particular debate here where we are having to be told that we borrowed the Eurobond. So we borrowed the Eurobond, I think, a number of years back, but it is this time the dollar went up, really up. So we're having to be told by the government that in this case, they're having to spend more in terms of servicing the Euro bond. It is because now in this case, the Kenyan shilling had actually done weakened. For example, if maybe 4 years ago, the dollar was actually going maybe in this case for 150 shillings. So it means that they were having to repay back at each and every dollar 150 shillings. But since now in this case, the dollar has actually skyrocketed in terms of the exchange rate. It simply means that the cost of this kind of borrowing had risen. So there can be these exchange differences causing the cost of borrowing having to do to rise. Or maybe in this case, to have what you're calling a cost of borrowing. So of so much importance under this particular standard, it is that during your normal operations as an entity, maybe in this case, you could be involved in having to do maybe undertake what you call construction, or coming up with what we call certain assets. So these assets will end up having to incur what we call a cost. And of course, this cost you're having to incur, part of the amount you would have spent on this, for example, construction, could have arisen from maybe in this case what you're calling the borrowing cost, could have arisen from what you're calling the borrowing cost. So under this particular standard, so the borrowing cost directly attributable to the cost of construction, or maybe coming up with a qualifying asset. So those costs should actually be included in the cost of that asset. Let's say, for example, in this case, if you end up having to construct a building, you constructed a building. So the cost of constructing this building, so you've already been able to do, for example, your evaluations with the engineers. So it will end up having to cost, let's say, for example, maybe in this case, 8 million. So 8,000 can end up to cost, let's say, for example, 8 million. But now this amount you don't have as a company, you'll borrow. You'll end up having to borrow. So you'll end up having to borrow the amount, maybe from a bank, or you'll be financed by a bank. So you'll borrow the 8 million, but now the requirement under International Accounting Standard number 23, it is that the total cost of this particular building, you should be able to do what? Include the interests for the period under which the construction was having to be undertaken. Let's say, for example, if you borrowed on 1st of January 2024, and the construction took, let's say, for example, 6 months. If it took, for example, 6 months, it simply means that if the rate of interest is maybe 10%, exactly 10%, so it means that the total cost of having to construct this building, you'll have to include the interest for the period upon which you are actively having to come up with what these qualifying assets. This qualifying asset, the asset that in this case will be utilized in the long term by what the reporting entity, or maybe by a company. So it means that the total cost here, you'll have to include what the borrowing costs for the period upon which you are actively having to come up with what that building. So the initial cost, as per the evaluation of the engineers, 8 million, but you didn't have the money you borrowed from the bank. During that period upon which you're having to construct, this loan you borrowed was having to accumulate interest. So the total cost here will include the borrowing cost you actually incurred in terms of what having to borrow this amount, that interest, for the period upon which you are actively having to come up with what the construction. So if it took 6 months, maybe from constructed from 1st of January up to the end of the month of June, so 30th of June 2024. So it means that you'll have to include in this case 10% of the 8 million by 6 months. So because the total interest up to that point in time will be half a year. So it means that, for example, in this case, it will be, is it 0.4 million. So the total cost here will end up having to be 8.4 million. So this will be the cost that in this case, you'll, for example, transfer to the statement of financial position as what? As the cost incurred in having to come up with what? This building. So under International Accounting Standard number 23, so point number 1 that is actually very key. In any case, for example, there are any borrowing costs you incurred. For example, in coming up with what we call a qualifying asset. A qualifying asset. A qualifying asset. A qualifying asset. And what we mean by a qualifying asset in this case is an asset that takes what? Substantial time, in this case, having to come up with it. And of course, now in this case, it will be ready for use after that construction will be coming up with this asset, and it will be utilized for the long term. So that becomes what? A qualifying asset. For example, it could be a construction of maybe what? Building, a factory building. Maybe in this case, it could be maybe you're having to come up with what? A go down. So it could maybe go downs for maybe in this case, storing your goods, or maybe in this case, you could actually basically be wanting to raise money, in this case, to maybe come up with what? Equipment, or maybe machinery for manufacture. So that becomes what? A qualifying asset. So the total cost of that qualifying asset will be, for example, the initially estimated cost plus all the total borrowing costs. So that basically now in this case will accumulate the total cost of the asset to be transferred to the statement of financial position. So that is in regard to the requirements of International Accounting Standard number 23. But there's something in this case we've been able to, for example, omit in our, for example, calculation. For example, there's this interest that was actually still having to be accumulated subsequently after this particular date. It doesn't mean that in this case, once you repaid the interest for the 6 months, then the interest has already been recovered by the lender. There's still some other interest that is there. So that remaining interest that was not actually part of the construction. That was not actually, for example, during that period upon the building was actively having to be constructed. It means that that interest will be expensed, will actually be an expense, So from the month of June, that is July subsequently, because maybe in this case, they'll end up having to pay the loan for like 4 years. So it means that the remaining 3.5 years, that particular amount of interest will be an expense, But this interest that in this case was having to be accumulated during the period upon which they were coming up with a qualifying asset for which the money was borrowed, that one will be included as part of the cost of the asset. So hope you're having to see the difference. So the interest in this case that was there during the period upon which the construction was not actually having to actively to be undertaken will actually be expensed, will actually be an expense in the statement of income. But of course, that interest upon which was having to be accrued, basically was arising during the period upon which the asset, the qualifying asset, was actively having to be, for example, constructed, will actually be accumulated as part of what? The cost of the asset, as part of the cost of the asset to be transferred to the statement of financial position. So that is, in this case, part of the key points that in this case, you must actually be able to. So we've been able to talk about what? Maybe there can be interest that in this case has actually arisen as a result of what? You having borrowed money to come up with a qualifying asset. A qualifying asset, simply an asset that will take quite substantial time to be able to come up with it. For example, a factory building. So in any case, for example, there is any borrowing or amounts that were actually borrowed, for example, to construct this particular building, it means that interest incurred during the period upon which the construction was having to be undertaken will be included as part of what? The cost of that asset. But interest incurred during the period upon which the building was not actively having to be constructed will actually be expensed, will be what? An expense. So sometimes, maybe in this case, it could be you have actually borrowed the 8 million. You've actually borrowed what? The 8 million. You've actually borrowed what? The 8 million. But now it simply means that these amounts, you won't spend the whole of it. For example, within what? Maybe the first 4 months. Remember, you're having to say that it will take what? 6 months. It will take 6 months. So that is from 1st of January 2024 up to 30th of June 2024 to construct. So we've said this particular total interest here, you'll end up having to do what? Include as part of what? The cost of what? This particular asset, the building. So which we've seen it will come to around 8.4 million. But maybe during this particular point in time, up to, let's say, for example, the month of March, up to the month of March or end of March. So these are 3 months. Maybe these are 3 months. During this point in time, maybe you can, you might have, in this case, be called upon to spend maybe 4 million and 4 million, which will total to 8 million. So the first 3 months you're estimating, you'll spend 4 million. And of course, the last 3 months, you'll spend what? 4 million. So what you can be able to do with this amount, instead of it having to lie in the bank, you can do what we call what? An investment. You can invest the money. You can do what we call what? Investment. So maybe in this case, you can end up having to invest in, let's say, for example, treasury bills. Treasury bills. So we have in this case, treasury bills for like 6 months. Is it 6 months, 9 months, or 3 months? So T-bills of 3 months. To invest in the T-bills of 3 months, and maybe in this case, you're having to earn, let's say, for example, 10% in interest income on what? This amount. So remember, you borrowed the money for construction, but you won't use the money at all, the whole of it at the start of the project. There'll be some amount that will be required to finish up the project. So instead of it having to lie in the bank, you invest. When you invest in this case, you'll gain what you're calling what? Interest. It will be an income. So this interest you gain, you'll end up having to reduce this particular what? Interest cost for construction. You'll end up having to reduce this interest cost for construction. Remember, you ended up having to incur this one on construction. But before the project elapsed or the construction was actually through, you invested part of the amount, for example, in treasury bills. Then you gained interest of 10%. So it means that if you invested these particular T-bills for 3 months, let's say, for example, from maybe January up to the month of March. So in this case, you'll end up having to calculate the income here. It will be 3 out of 12 times the 10%. times the 4 million, which you've actually been able to invest. So of course, now in this case, I think it will come to around 0.1 million. So 0.1 million, 0.1 million, it will come to 0.1 million. So it means that these costs, you'll reduce it by 0.1 million. Because you invested, you got extra income from the money you had borrowed. So it basically reduces what? This particular what? A cost of construction by 0.1 million. But of course, now in this case, this will only be during for that period upon which the construction was actually actively having to be undertaken. So the income gained on the amount borrowed for the period upon which the construction was having to be actively undertaken will be reduced from the borrowing cost incurred on what? On the construction. From the borrowing cost incurred on what? On the construction. So maybe in this perspective, when we look at an example, is when in this case you can be able to understand what we are having to mean. So any other, for example, interest that was actually incurred during the period upon which the construction was not actually active, or for example, the qualifying asset was having to be constructed, that kind of an interest will be expensed. But that interest that in this case was actually incurred on the borrowing during the period upon which the construction was actively having to be undertaken will be part of the cost of what? Of the asset. In any case, during that period upon which the construction was actively having to be undertaken, they invested part of the borrowings, let's say, for example, in treasury bills, and they gained some kind of an income. That income will reduce what? The borrowing costs for the construction. Will reduce the borrowing cost for what? For the construction. So we're having to say that in this case, of course, you have the borrowing costs, in this case, under International Accounting Standard number 23. But of course, also in public sector accounting, accounting, whereby in this case, we have public sector entities. So sometimes in this case also, they can end up having to incur what you're calling what? Borrowing costs. So what happens? What is the difference between now, in this case, treatment of borrowing costs under International Accounting Standard number 23, and of course, under International Public Sector Accounting standard. So the difference is that in this case, all the borrowing costs, in this case for public sector reporting entities, will actually be expensed. But of course, in this case, under International Accounting Standard, you'll be able to see the difference. So the interest in this case is, for example, treated in two major ways. That in this case, interest accrued during the period upon which the active construction was having to be taken, you expense. You actually include it in the cost of the asset, but any other interest, you expense it. And of course, that interest, you include it as part of what? The cost of the asset. So we can look at an example. So that in this case, you see what we are trying to explain here. And of course, in this case, how you can be able to end up having to undertake what? The computations regarding borrowing costs as per the International Accounting Standard number 23. So we are going to look at a question. I don't know if you have the past papers. You can open a question. So there's a question for December. December 2022. Question number 3B. If you're able to get the past paper, that particular past paper, you can say yes. If you are there with that past paper, you can say yes. If you're able to get the past paper there, say yes. December 2022, question number 3B. Question number 3B. If you get the past paper question, just say yes, so that we know whether we are together. Let me try to get it. So that I share. Yeah, I think I've shared. So confirm whether you are at that particular question so that we can be able to move together. Confirm whether you are at that particular question. Confirm, confirm, confirm. Have you been able to get the question? So, or you can't be able to access it? Are you able to get the question? So if you are together with the question, then I think we can proceed. We can proceed. Confirm. I want at least a confirmation of 1 or 2 people to confirm through the chat. You simply say yes or no, or we haven't gotten the question. It is December 2022, question number 3B. So we can look at the question. So it says Sayari Limited obtained 10% loan, 10% loan not amounting to 24 million on 1st of January 2021 to finance the construction of a new factory. So here, our qualifying asset in this case was construction of what? Of a new factory. So construction of a new factory. Construction of a new factory. So they borrowed some amount there. So obtained a 10% loan not amounting to 24 million on 1st of January to finance the construction of a new factory. As the funds were not all required immediately, Sayari Limited invested 10 million in a 6% bond until 31st of May 2021. Construction of the factory began on 1st of March 2021. However, due to an expected shortage of skilled labor, the project ceased during the month of July and August. By 31st of December 2021, the project was not actually complete. Explain with suitable calculations the accounting treatment of interest on costs on the loan notes in the financial statements of Sayari Limited for the year ended 31st of December 2021. So the accounting treatment of the accounting treatment. So the accounting treatment, explain the suitable calculations, the accounting treatment of the interest on costs. So the accounting treatment, so the borrowing costs. So this is actually for the year 31st of December 2021, December 2021. So remember, we're having to be told that in this case, this amount was actually borrowed on 1st of January 2021, 1st of January 2021. But the construction began 3 months later. It actually began after 3 months. The construction began after 3 months. So that is actually on the construction of the factory began on 1st of March, 2 months later. So that is on 1st of March. So 1st of March 2021. Then so they continued the construction. So this is when there was active construction of the building. Active construction of the building began here. So, but of course, now in this case, they went up to the month of unexpected shortage of skilled labor. The project ceased during the month of July and August. So July and August, there was no construction. July and August, no construction at all. No construction at all. There was no active construction. Still the same case here. there was no active construction of the building. There was no active construction of the building, no active construction of the building. So it means that when we'll actually be computing the borrowing costs to be included in the cost of this particular new factory, we'll exclude this particular 2 month, this particular 4 month. So these are 2 months, then again, this particular 2 month, it becomes 4 months, where there was not actually no active construction. So the cost of, in this case, for example, construction, so the total interest, so we have the total interest, so the total interest, construction of new factory. So total interest here, total interest, of course, it is actually 10% of the amount that was actually borrowed. 10% of the amount that was actually borrowed. 10% of the amount that was actually borrowed. So that is 24 million. So if we are able to put in shillings of 1,000. So if you calculate 10% of this, I think you'll be able to get 2,400. 2,400. But now we have to exclude this one because the interest here on the loan here and also the interest here has to be excluded. So it means that in this case, we'll end up having to exclude. So you'll have to less. You will have to less the pre-construction period interests. Pre-construction period interests, which was actually 2 months. So it will be 2 out of 12. 2 out of 12 by 10% by 24 million, by 24 million. So I think you'll be able to get 400. So you'll have to exclude this one, you reduce. Still the same case, there was a period of dormancy here. So the period of dormancy, so there is dormancy period when there was not actually construction. So that interest you don't actually include on the borrowing cost. Dormancy period interest, dormancy period interest. So it will also still be 2 months, just the same, by 24,000. So it will come to 400. 400. It will come to 400. Come to 400. So that I think will be 16. Is it 16? 1.6 million. 1.6 million. But now in this case, we've been told part of these amounts was actually done what invested. So we said in this case, in any case, during the period of construction, part of this amount was actually invested. Then that income realized or maybe gained during that period of, for example, construction, it simply means that in this case, you'll have to do what? You'll have to reduce on the interest. You'll have to reduce on the borrowing costs. You'll have to reduce on the borrowing reduce on the borrowing cost. So you're having to be told that in this case, as the funds were not all required immediately, Sayari Limited invested 10 million in 6% bonds until 31st of May. So from this, remember this case, the amount was borrowed here. So for 5 months, for a period of 5 months, the amount was actually invested. It was actually invested in what? In bonds. It was actually invested what? In bonds. But remember now in this case, the construction began when? It actually began on, 1st of what? 1st of March. So it means that in this case, the only valid period upon which, for example, interest was gained when the construction was actually happening or maybe occurring, it was only how many months? 3 months. So of course, the total interest gained here on the bonds, so interest on investment, so you'll have to less interest on investment. You have interest on investment. So interest on investment, interest on investment. The interest on investment, you'll only be able to take 3 months. Just take 3 months. So it will likely only be 3 months. Hope you can be able to see, because there was a pre-construction period of 2 months where there was no active construction. But they invested in what? In bonds for 5 months. So the first 2 months, there was no construction. No construction. So simply there was no construction. These won't actually basically be part of, for example, that amount that in this case will end up having to reduce what? The cost of what? Borrowing. The cost of borrowing. So we'll only be able to consider what? The 3 months. The 3 months upon which there was actually what? Active construction. And this 3 months, that interest gained from the bonds will reduce the borrowing cost, So interest on investment in bonds, during active construction, period, it will likely be 3 months. It was 3 months out of 12 times. The interest was, I think, 6%. So 6% times, I think, 10 million. So they invested 10 million. So they invested 10 million. They invested 10 million. They invested 10 million. They invested 10 million. So I think you'll be able to get an amount of, I think, 150. Should be 150. It should be 150. 150. So this one will reduce the borrowing cost. Will likely reduce the borrowing cost up to an amount of 1450. So this is actually the borrowing cost that was, in this case, incurred in the construction of what? Of the new factory. In the construction of what? Of the new factory. So the borrowing costs incurred. So the borrowing costs incurred in the construction of what? Of the new factory. So we've been able to consider the interest. This particular two are basically excluding the interest during the inactive period. So what is actually remaining here, it is actually only interest on the borrowing during what? The active period of construction. But of course, now in this case, there was income gained from these amounts borrowed during the period of active construction. So you have to reduce it. We have to reduce it in this case from what? From the cost of borrowing or the interest or incurred during the period of what? Of construction. So you'll end up having to realize the borrowing cost down there. So this amount is on that we're having to say you'll be able to capitalize or include it in the cost of what? Of the new factory. Include it in the cost of the new factory. And in this case, it will end up having to go to the balance sheet. For example, in this case, if the new factory was to, for example, in this case, they were to utilize the 24 million. So they were to utilize the 24 million. It means that in this case, on top of the 24 million as the total cost of the new factory, you'll have to add this amount. You'll have to add what? This amount as what? The borrowing cost. So in short, the borrowing costs here are normally capitalized and included as part of the cost of what? A qualifying asset. As part of the cost of what? A qualifying asset. But any other interest that is not actually part of, in this case, the qualifying asset will actually be expensed, will be an expense. It will be an expense. So what we simply mean by this, it doesn't mean that in this case, after the construction was actually over, that they were not actually paying interest, maybe to the bank. They were still paying interest, but that interest won't actually be part of what? The cost of construction. So it can't actually be capitalized. But in this case, it will just be recognized as what? As an expense. So ideally, that is in this case how you deal with what you are calling what? Borrowing costs. Borrowing costs having to affect, in this case, what you are calling what? The qualifying assets. So they'll be capitalized. These borrowing costs will be capitalized to be included as part of what? The cost of the asset. As part of what? The cost of the asset. So I don't know if there is any question up to that point in time. Any question up to that point in time? Any question up to that point? 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 If there isn't, then I think we can end there for now. We can end there for now. We catch up later. So if you happen to have joined us for the first time, then you can get connected to our sessions when you reach out to us through the customer care numbers, which I was able to indicate as we started the class. So you can call these numbers. You'll likely be assisted as to how you can be able to join the sessions. So these ones. Otherwise, thank you very much and enjoy your weekend.